Greetings, Professor McKee here with the next episode in Seminar Saturdays. This week we're talking about a paper on Twitter and stock market participation. So this paper is about social media, called Social Media and Stock Market Participation. This is by Carsten Muller, Yannian Pan, Carlos Schwarz. I apologize if I mangled anyone's name there. And this paper was presented at AFA in 2025. So this was an AFA paper. It's a working paper. It has not yet been published. And this builds on Twitter data from a 2023 paper by two of the three authors on this one. They're using the same data set for looking at a different question. And what they're looking at is if the social media, Twitter in this case, is affecting stock market participation. You might remember we had a previous paper this semester also on stock market participation. This was coming out of Taiwan, looking at social networks through the military draft. That was in week 6, if you want to look at that again. And they have a similar idea here. In this case, it's looking at connections through social media, increasing participation versus connections to fellow members of the military. And there's plenty of survey evidence that investors, especially young retail investors, and also many institutional investors, are using social media for investment advice. Twitter's a common place for this, as well as, of course, other social media outlets. So the idea, the story that they're looking for is that we have social media. This decreases friction on gaining information. It's easy to use, so it means it's easier to know more, and therefore you participate in the stock market more. And there are certainly many previous papers claiming that the cost of information, of acquiring information, is something that reduces stock market participation. So if social media is decreasing the cost of information, you would expect participation to go up. A competing alternative story, one that they are going to not find evidence for, is that the social media creates less participation because the information isn't as accurate or there's too much information. It's information overload. Again, it's because of the less friction, it's just there's too much information. We are paralyzed and don't know what to do. So they're setting up two competing theories here, a common approach for a paper to try and establish contribution. The first story, that there's more information which leads to more participation, is what they will find. Another suggestion I would have, if I was a discussant or a referee in this paper, was that perhaps the social media is just replacing previous information sources and doesn't change participation. They actually have some evidence that it does replace previous information sources, but it seems to decrease perhaps for friction, and so we still see more participation. So that's another suggestion for a competing hypothesis, another one that they could set up to just knock down. Now, the problem with this paper is people don't randomly start using social media. People choose to do it. So that choice could be caused by other things which also cause people to participate in the stock market. And perhaps it's a willingness to try out new things. So you try out the stock market and you try out the new social media platform. So what they need is a type of natural experiment that increases or decreases social media use. And then they link that to the stock market participation to get their causality, so we know if Twitter or social media causes an increase or if it's something else that's causing both Twitter and stock market participation. They use Twitter, which is useful for them because there's a substantial connection. There's a lot of talk about investment on Twitter. And for their natural experiment, they use South by Southwest, SXSW. In 2007, Twitter was picked to showcase their new app product. Twitter was pretty new back then, during the festival. This was a major event that, according to the authors and some of the people they are citing, triggered Twitter's network to reach a critical mass. So there was an increase in Twitter registration among attendees. That itself was a choice, but there was also an increase in registration for Twitter accounts among people living in the same county as the people going to the festival. That was not a choice. We don't send people to this festival. If you're living in the same county, you probably have no idea that there's people going to this festival. And they show, and they say, there is an increase in Twitter activity that's still visible even as late as 2015 for these affected counties. So it seems like it was a very long-term effect on higher Twitter use. So they use an instrumental variable approach where they look at Twitter activity in 2015, channeled through the exposure to the 2007 festival. If you had attendees at that festival from your home, from your county that you're living in 2015. The useful thing for them here is how long the time. There's 8 years apart. So that rules out a lot of potential stories. They also have a ton of controls that they include. They rule out some other potential effects as well that we will see in later tables. But the core idea is some people who live near you went to this festival. They started using Twitter because they went to that festival, and then you started using Twitter because of your neighbors exposing you to it. And so that's the causality, because the only reason you're starting to use Twitter is because of that exposure. Now, in terms of data, they have a lot of data. So their stock market participation data is based on tax return data. So IRS provides the public tax data that's aggregated at a county level, and it includes AGI. It also includes dividend income. Now, if you have dividend income that you're paying taxes on, you have to have participated in the stock market. Otherwise, how would you get the dividend income? It's the same logic that the Taiwan paper that we saw previous in the semester used. They have Gallup survey data on stock ownership that helps them validate their proxy for dividend income as a measure of participation. They look at total wealth earned. There's some papers that measure that. There's Twitter county level activity that they measure based on a third paper. They get the South by Southwest attendees. That follows the previous paper's procedure. But the idea there is if you have a new Twitter account in 2007, which is the month the festival happened, and you follow that account, you're considered a new person who attended. So they don't know exactly when they started following, but they assume it's connected to attending the event in 2007 and starting Twitter. Given the timing, it's pretty likely that yes, you started using Twitter because you were going to that festival. They also have a bunch of additional data. So they use Google Trends for some search data. There'll be some tests involving popular meme stocks like GameStop. They have trends for metropolitan areas, which doesn't exactly overlap with counties, but they can kind of merge it with a larger group of counties. They have discussion of financial topics from Factiva, lots of county-level demographics from lots of sources, mostly government, like U.S. Census, BLS, BEA, FDIC. They have a financial literacy measure from a FINRA survey. I've used that. That's a statewide survey. And many other sources as well. They have a ton of control variables. Now, in terms of Twitter adoption, so 2007, the dashed line here, that is when the festival happened. So the first figure here is tracking the effect of the festival on Twitter adoption. So there's additional people using Twitter, and as we can see, it's going up, and there's especially a big spike in 2008, but it continues to increase and more than the base amount that we would expect, which is this black line there, and it maintains a higher presence and an increasing one throughout all these years. So people are definitely using Twitter more following this festival, and we think it's caused by the festival. And then because they're doing an instrumental variable, They also want to look at Twitter registrations around the festival. Twitter registrations are not really changing, and then they start jumping up above that black line, so you can see how these confidence intervals are all higher than the black line. So you have statistical significance here that the Twitter registrations are increasing following the festival. So that's just try to help validate the story that they're going with in terms of getting the causality. Okay, so let's look at what happened with dividends. So they look at the change in dividends from 2005, which is a couple years before this shock that increases Twitter usage, to 2015. So there's a 10-year gap here. And Twitter users using following through the South by Southwest shock have an increase in dividends. And they have all sorts of control variables that they're adding in, and it still is showing up. Do note here the f-stats. They have 50, 47, 91, so they have very strong f-stat. This is for the first stage regression that they're not showing. And one of the two criteria for an instrumental variable is that you have a strong f-stat, so you don't have a weak instrument. An f-stat of 50 is plenty strong. So they're good there. The real issue, like usual, is the exclusionary requirement that this is only caused through the South by Southwest. There's not something else going on. So they're, based on their estimates here, a 10% increase in Twitter activity channeled through the South by Southwest exposure means you had a 1.8% increase in dividends per capita. Okay. So they use other measures of stock market participation to try and show that it's robust. It's not just based on some weird thing with dividends. So they have dividends divided by the tax filers. So dividends per people that are filing taxes, that's going up. Dividends per person's income, that's going up. Dividends per population. And now we're looking at just participation in 2015, not the change in participation. Those are all going up. Wealth, capital gains over stock wealth, the change in stock wealth or per population, all that is going up. So lots of measures of stock market participation, some measures of wealth, which may mean participation is more beneficial, but of course their wealth increase could be coming from other sources besides their increased participation. The next thing they look at is who is driving this increase. Is it people who already own stock? That they call it the intensive margin. Or is it new people who never owned stock before who are buying it? So is it current stockholders putting more of their capital into the stock market, or is it brand new stockholders? And they kind of helpfully break down their measure here. So dividends paid per number of tax returns. It could be number of returns over number of tax returns times dividends paid over number of dividends. So these returns with dividends would cancel out, and you're left with an equation that's identical. So this first one is the extensive margin. That's what they'll check to see if people who never owned dividends before are suddenly reporting in their taxes that they have dividends now, or is it just dividends paid total has gone up and it's coming from people who currently own stock. So there is an increase from both. So this is the total increase, and then number of dividends divided by the tax filers. You have 0.09, 0.15. If you add them up, it's basically the total amount here. So if you recall, our extensive margin was dividends over tax returns. This is the new people, so about 1/3 is coming from the new people, and then the rest, the 2/3, is coming from greater participation among people who already were participating. So it's coming from both, but it's more coming from people who already had investments. They're just investing more. Okay, so that's their main result, more participation. and they're going to go through a number of robustness tests that I'm also going to talk us through. So the exclusionary requirement is that the influence of the South by Southwest attendees on participation only happens through Twitter usage. So these people going to South by Southwest, they're only increasing the stock market through the increase in Twitter. They're not causing the increase of stock market from some other thing that they are causing. So they propose two possible problems, alternatives, besides Twitter, of how these attendees might be causing stock market participation. So the first one, which makes a lot of sense to me, this is sort of a techie sort of festival. Are counties with more attendees also more likely to adopt new technology, which would then improve productivity? If you have more money, you tend to participate more in the stock market. Not a particularly surprising result. This is well known in the kind of financial literacy, household finance sort of literature. And this would not be Twitter causing the increase in participation. It's just you have more money, so you participate more as you're saving. And then the other story that they use is, in 2007 was right around the financial crisis. There's a big housing boom, pre-financial crisis. And could that be causing them to attend because you have extra money, so you want to go to this fun festival, and also you participate more because you have more money? Again, it's that same wealth effect. I'm not super convinced about the housing boom because, I'm not sure that having more money on your house means you're going to go to festivals, but they test both. All right, so in terms of wealth for our treated counties, the counties with the high attendees for the South by Southwest festivals, there's no increase in GDP if you're exposed to these new Twitter users, or income per capita, or more employment, or even employment in related industries like finance or tech, or interest in a popular fintech platform, Robinhood. It doesn't seem like there's much going on there. So the wealth isn't really increasing for these treated counties. That kind of rules out both alternatives, because both alternatives are relying on your income and your wealth is higher, and therefore people in that county participate more. And they also do some tests looking specifically at housing things, so housing price indices, mortgages, debt to income measures. All of these are just nothing is going on there, and it's all coming from just the Twitter. So there's no evidence that the housing boom was driving it either. But we sort of knew that already because there was no wealth effect going on. Then they step into some additional kind of subsample tests here. So are there some sort of characteristics related to the county or the personal characteristics that are where we see the results concentrated? So because probably the Twitter effect is not going to be randomly distributed across everyone in the county. After all, if our story from the authors is correct, it's going to be driven by people who have connections to people who went to South by Southwest. Because that's how you find out about Twitter. Your friend went to South by Southwest, and now you start using Twitter too because your friend's using it. And then because you're using Twitter, you start participating in the stock market more. And there's a lot of previous study on stock market participation. I kind of had a paper discussing it already in this seminar, this semester. And one thing that they're going to look at is high income individuals, because we know that when people have higher incomes, they are more likely to participate in the stock market. So they look at splitting our sample based on income. So they look at 5 different buckets for income. And what they see is that the increase in dividends only shows up if you have income greater than 100,000. So you have to have a fairly high income before this Twitter effect actually does anything. Otherwise, there's no change in your dividend income if you're below 100,000. They also look at some demographic characteristics. Technically, everything here is statistically significant, but just do note when you interact with the Gini coefficient, the poverty rate, just the total population, this is at the 10% level, so this is a pretty weak statistically. I'm not very convinced this is actually happening. But one thing that definitely shows up is that if you have a higher percentage of the population that is white in that county, and you interacted with the exposure to the South by Southwest, there is not, it drives the increase down. There's actually a negative effect on your dividend per capita. So if you have a low percentage of white population in the county, that's where you're seeing the increase in stock market participation. Also, if you have high income, people with high incomes. And again, there's very weak evidence that income inequality, poverty rates, total population are increasing it, but again, statistically, those are quite weak. I would not trust them very much. They next look at the channel. So how is it driving the increase? We know the kind of people who are increasing participation, and we know that participation went up overall, both among people who currently already had participation, and people who had no dividends at all. So how did Twitter create the increase? The information channel is the likely story here, right? People know more about stock market, they know more about investing because of Twitter. The other thing they look at is if there is some sort of trading frenzy because of social media misinformation. So what they do is they look at a short squeeze that happened in 2021 involving a number of meme stocks like GME, AMC, several others. And there was a lot of attention being paid to these meme stocks on social media. We kind of know that from the name. Actually, I had a podcast I was a guest on discussing that short squeeze with one of my colleagues here, Dr. Stitzel. I'll have a link to that video podcast in the description if you want to learn more about this short squeeze. But first, financial knowledge. So they have interactions here with a couple of proxies for other sources of financial knowledge. So the more financial advisors in the county per capita, more bank branches per capita, higher education, and also their self-reported high financial knowledge, which I'm not really sure how they get this per county because the survey is a statewide survey. But regardless, what they find is that these are all negative interactions. So if you have other sources of financial knowledge, the influence of Twitter is going down. It doesn't increase as much. These results are not super strong, but they're all really consistent with each other, and they're all trying to proxy for the same thing. So it seems like one channel that does exist here is that people who already knew about the stock market are increasing their participation less than people in counties where there was less exposure to financial knowledge. And they have some surveys from Gallup looking at what sort of investments people are interested in. People are reporting more stock ownership when you instrument it on the Twitter, and they're also more interested in stocks and less interested in some alternative investments like real estate and gold. So it seems like their increase in knowledge is driving them towards stocks and away from other investments, which of course we see more dividend income. Gold doesn't generate dividend income. Real estate might, but gold definitely wouldn't. Now, in terms of the sort of the Twitter frenzy type thing, they also find evidence, pretty strong evidence for this too. So Google searches for these types of meme stocks, which they include a list in the paper. It's GME, AMC, several others. That is going up a lot. And this is all focused around 2021 when the short squeezes were happening. So there is kind of the short-term fad sort of interest in individual stocks, but also in kind of probably what we in finance would view as a better channel of them sort of adding information, replacing traditional sources of information. So how did Twitter create the increase? It looks like it both increased your financial knowledge by substituting for traditional measures of financial knowledge, and also driving an increase in meme stocks. So some probably good ways and some maybe not so great ways in terms of financial health. And that is the entire paper. So they have hopefully an exogenous exposure to Twitter, which they find an increase in stock market participation. It appears that it's only happening for non-white and higher income populations. And it's involving both new participants and more investment from those who are already investing. And the information channel appears to be both by just more information that's substituting for previous sources, but also kind of faddish meme stocks as well. They don't really look at if the increased participation actually benefits these people. You know, is their personal wealth going up because they participate? And we don't really, it's hard to know for sure, because if you're participating in this sort of broad market index, it's probably benefiting you. But if you're blowing a bunch of money on meme stocks and you're losing money on it because you're chasing after these fads and the stock comes back down after you've bought it and you take a huge loss, maybe it's hurting your personal wealth. So they don't really look at that. I'm not sure if they have enough data to really do that, because a lot of their data is aggregated to the county level. They don't have the individual tax returns. You might be able to see that individual tax returns are reporting reduced wealth if you could see that, but they can't. All right, so that is this week's paper, and the next week, and I think the last week for our spring seminar series, will be another paper from AFA. I'll see you next week.